mile 24. Probably sounded like a dog that got shot. Let out a yelp and freaking went to the ground for a minute in time.
Oof.
I called Aaron. I was like, "You gotta come pick me up."
Oof.
Then I called her like 5 minutes later, and I was like, "Nope, I'm gonna finish it. I'm fine." It's
I'm gonna
probably
suck it up.
stupid.
I'm gonna suck it up.
So no, we'll see how it. I'm gonna have to take probably a week off. We'll see how it goes. Not fun. Let me get some charts up here. That's so mad. This is the last big run of training. It was like the last straightaway. It's probably like 3 or 4 miles from home.
When's the race date?
25th
of January.
Yeah.
Oh, okay.
Yeah, I know. It's not. Yeah, I know. I'm gonna go into physical therapy for my hips. I'm gonna be like, guys, can you please help me do something here?
All right. Well, hopefully you'll feel better.
Yeah, we'll see.
So Chuck's asking to go over how to identify dealer adjustment bars.
Yeah, we can hit on that. Yeah, Horn Dog. Okay, cool. The sound's good. Good evening, everyone. Yeah, if you guys have questions, pop them in the chat, pop them in the Discord. We can answer them throughout. Let's see, SPX right now is trading 68, 65, kind of within yesterday's range, Friday's range. Yeah, market trend model real fast. Paul, I think you posted a note on Friday or whatever, like this is not a bullish signature right now. So for those that are, read through our documentation on our mechanical strategies, those are turned off right now in terms of entering new long positions because, TC34, if you're familiar with that, or, a bullish momentum indicator, which is cumulative tick above the rainbow ribbon, moving average, longer term moving average ribbon. Obviously, that's below it right now, and that's kind of a key gate. Back tests very well. That's why we use it. So our P2P strategy, our wheel strategy, those are not taking new entries at this point in time. Even just from a discretionary point of view, right? You have the railroad tracks with the shorter term moving average ribbon. Those are trending down. Yes, I know we're talking about moving average ribbons, long-term, short-term, but, these are all back tested. We have a tag combo system. Right, I'm not going to go through the nitty-gritty of that because some folks on here don't know what that is, and the folks in the Discord should know what that is. But if they don't, and there's questions, then we're more than happy to cover it today.
Sure.
But that is kind of more nitty-gritty. Just to suffice to say, right, cumulative tick, trending lower. So yeah, just from a swing trading point of view, right? If you think about the dimmer, long, it's getting aggressive. Not getting aggressive, my dimmer is towards off right now. So not super excited about entering swings in this environment. I have a couple, legacy swings that were put on. And by a couple, maybe like 1 or 2 positions, I think. But yeah, I've not been actively putting on any new positions right now in the new year.
Yeah, but there was broad buying across the internet, and FinTwit says that the rally's intact, and everyone you're just being head faked by the Mag 7 being rotated out of into all these other stocks.
Yeah, well, I got 50 more years of investing, God willing, and thousands more trades, so I'm going to trust our tools, and if I don't miss the exact turn, that's all right. But, we're pretty good at catching the meat of the move. So if you're wanting to catch the exact bottom and top, probably going to be disappointed, although we're pretty good at seeing the turning points. So, yeah, kind of what I got to say about that. I don't know if you have anything else to say about that, Paul. Man's got to have rules in his life, all right? If you don't have any rules, then it's not repeatable, not systematic, nothing like that. So if you want to I tell these people all the time, like if you're dependent on our morning updates in Twitter to make your investing decisions, trading decisions, or anyone, that's like the not smartest technical term way to go about your trading. Okay. So, so yeah, we're going to keep doing what we're doing, and, knowing it's July 4th, not going to, or January 4th of a new year, not going to freak you out here. Which leads me to my other point, which is a running thought. Then we can get into some questions. Just because it's a new year, like that's just a concept of time, right? You place whatever importance you want to on the turning of the calendar, but just because it's January 1st doesn't mean that all bad habits you had last year are magically going to be gone. It's like if there's an issue you had, then like you need to figure out in your system where the breakdown is and how to correct that, right? Just because it's like, oh, a new year, now I'm going to do this thing right. It's like, okay, well, what have you done or put in place or whatever to actually prove to someone looking over your shoulder that, yes, you're probably not going to make that mistake again that you kept making last year. So, yeah, all that to say, right, if you want to, improve your trading this year, then do it. Put, rules in place, guardrails in place. If you have none, you need to figure out what that is. Like we have some core ones at Game Edge. Happy to, show you what those are. But yeah, I mean, just pretend, you're looking over someone's shoulder when you're trading. That's been helpful for me. Pretend like, what you're doing is going to be on the front page of the Wall Street Journal, right? Because, you don't have a boss in trading except yourself. So it's very easy to be 4 to 5 trades deep in a day, revenge trading, and be like, wow, that got out of control really fast. And then you look back when the market's closed, not emotional, and you're like, wow, there was a lot of stupid stuff I did today. But then you like don't do anything to correct it. And next thing you know, you're in the same spot tomorrow. So that strikes a nerve with some people. That's probably because there's some truth in your own trading of what I'm talking about. And our goal here is not to sugarcoat it, right? Like this is a very hard endeavor. If you treat it like a hobby, you're going to get hobby-like results. So, there's very, smart, sophisticated people in the markets. You don't need to be super smart or sophisticated, but if you have a very good process, demonstrates to make money over time, and you stick to that process, that's all you can ask for. So that's the soapbox. Unless Paul or Michael, you guys have anything else, I guess we can hit on Chuck's question about dealer adjustment bars.
I think you're spot on.
All right.
Let me just add this final bit of color, just a little bit here. If you really want to leverage what Taylor was saying, learn the tag combo system. And when you get into GE and you go over to what Huss updates every single day for us, you will find that the tag combos really tell you when you should be thinking of going long. And they're called trigger days. It's the start of a new trend. And when you get confluence across the different CT indications, you might want to pay attention to that. It takes literally, someone does all the work for you. It just takes you to the diligence and the rigor to click over into his channel once a day when you're doing your pre-market, and you're done. You're literally done. So I don't know what else to say. We can't make it any more easier. Maybe open up a fund and have people just send their money in, something like that.
Yeah, for real. So what Paul was talking about in the trading floor, market trend model game plan, right? We document that every day there. And then what Paul was also talking about, so in the Game Edge Fast Pass, which everyone has access to, or, if you go to our website, you can get access to that too. It's our entire education platform. Here under the market trend model lesson, which is what we've been talking about, at the very bottom, there's a mini lesson that covers that the trend combo, tag combo, specifically, right? We go through the files, we go through all the various, combinations, all that good stuff for you too. So yeah, and you don't need to get wrapped around the axle per se on all of that, but we definitely call out the important ones, the ones that are gating our system. And then we kind of go through just examples of the first time triggers, the conditions, transition indicators, stuff like that. So definitely worth giving it a read or asking questions, all that good stuff. So yeah, Paul, I don't know if you want to hit on dealer adjustment bars or kind of when you see them during a trading day, I guess what importance or no importance or whatnot you place on them, and specifically like dealer adjustment bars, through a level versus just a random one. If that makes sense.
Yeah, I don't know, Mike, if you got 2 cents you want to put into this too. But dealer adjustment bars, when you go to a 1 minute screen, not 5 minutes, not 10 minutes, not 4 minutes, 1 minute bars are faster. What you're looking for, and the reason I say those longer durations is people say, well, I only trade 5 minute bars. Well, okay, most likely you're not going to see a dealer adjustment bar. The dabs literally are stacked in the close of one bar, which let's just say it's bullish, it's moving up, represents the open of the next bar very, very close to it. And then you get another building bar on top of that. And then when that bar closes, the next bar paints literally the low of the bar is very, very close to the high of the previous bars. This stacking is called a dealer adjustment bar. And they're usually the same color, right? Positive or negative. They typically span a major gamma level or a major delta level, net OI level. I know your question, how do you use that in your trading? I think that's probably the more subjective question. You have to imagine, so if you were to look and say, I think I got a series of dabs that came in, dealer adjustment bars that came in. One of the first things that I do is I go over and I look at vol D, the volume distribution. And I want to see for that slice, I want to see a lot of either calls going in or puts going in that corresponded to the directionality of the dab. Right? So let's just take it's bullish. Green bars, boom, 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 over the course of a minute and a half, 2 minutes, whatever the number is. So in that 5 minute slice prints from vol D, you'll actually see not just one bar that's really, really big. It doesn't work that way. Dealers actually, when you learn what they do, you're actually going to see a lot of activity across a lot of strikes. And it's going to be a wide distribution. At that point in the price screen, you can mentally register they've hedged flat. The market has reset to that particular level. So if that happened 10 minutes ago, that becomes, if I start moving above that and saying, oh, we're coming up on another level, well, yeah, but the pressure that the market is feeling was just reset 20 minutes ago, and maybe it's only 10 or 15 SPX points ago. So actually, the offset that they're experiencing probably isn't that great. So the next level may not be as, we're going to get through this because they're, previous 2 hours from the open or 3 hours from the open, they're really extended. No, they've already reset once. Their risk desks in their organization are basically saying, we're good. Just let the market kind of unfold as it is, and we'll collect our money on the bid asks. So I think it doesn't have to sound complicated, and it doesn't have to be complicated. I think, Chuck, the takeaways are simple. Look for a series of very short bars, one stacked on top of the other, down or up as appropriate, through a key level. Generally, that's where I start throwing the term out. And go look at vol D. And if you see a lot of volume coming in not necessarily peak volume this way, but distribution volume this way. Strikes all stacked very nice and cleanly. 5, 6, 10 strikes are not uncommon when it's a fat distribution. You'll know it when you see it. And then okay, the new hedging level has been set up. I don't know, Mike, do you have any thoughts there? Any additions, corrections?
No, I think also Taylor and I both kind of use this language is there's an expectation breaker sometimes in price action, like as we come into a key level that we're not necessarily expecting to have a reaction off of, but if we don't have a reaction, we see those dealer adjustment bars through those key levels, and that you can see there what Taylor's shown is actually the low of the day. Well, was actually kind of the move up, and then we failed, kind of right where we were anticipating, but then we took out the low of the day, and you can just see those bars just continue to stack right through those. So that's an expectation breaker on a bullish side for me, at least, and that's flipping more bearish, and obviously that was already matching the MTM. So I think those are key areas to watch. Now, if we would have just came into the low of the day, not seen those dealer adjustment bars, and just kind of started moving back away from it, then that doesn't carry as much weight as breaking through the low of the day. So obviously that's even on a TA look. If you just threw out everything else's, that's very bearish breaking through the low of the day. I mean, that's basically saying that they're selling it all, at all costs through that low of the day, and then people that were holding out of the money calls or long calls are probably throwing in the towel. So when you see that, I think you have to understand both sides of it on the bearish and bullish thing. Again, not getting so deep in the weeds, but just saying, okay, if I'm bullish but I'm breaking the lower of the day and we're seeing these dealer bars stacked, then I'm probably on the wrong side of the trade. So that's just my only thought of that, because I think a lot of people just continue to hold their nose all the way down, and like there's nothing it's not gonna, most likely not gonna recover when you see these dealer adjustment bars just really flying down like that. So.
Right. Yeah, the SPX volume by strike graph and how you incorporate that into the trading, looking at the DAV. Yeah. I mean, so the volume graph just tells you that who is winning in that particular slice interval. And, you see price moving up with a large call volume outpacing put volume. I mean, we don't have to overthink it here, really. For that slice, the bulls were coming to town, right? And yeah, perfect. Yeah, I mean, there's, I think go to the after like right around 1400 there. I think that's a characteristic. No, you had it. No, I wasn't.
Sorry.
I was just directing their eye. So where it says 1400, that's 2:00 Eastern time. So you can see how price just took off right after the 2:00 time frame, right? But look at how the call volume is starting to outpace everything. And what Taylor didn't do here, just click back in the normal screen there, Taylor. So you see the blue links on each of these. So folks, always remember, you can always go get the interactive chart. That blue link is live. It links to the HTML chart. Okay, yeah, there we go. And see how you can hover over that, one of those green peaks. So let's just go grab that. So that you can see that's at 1430. All right, so 1430, we had a green spike. So let's go over to Valdi. And we're going to grab the 1430 slice. So again, go to the blue link where, differential volume. And you guys may not know how to do this, but if you scroll to the bottom, and you can click on the 1430, there we are.
And this is all transactions between 1430 and 1435.
Correct.
So people know.
Yeah. So there's a couple things going on here. So over on the left-hand scale, that's volume. That's literally per strike, okay, for that window. I know it says value, and we got to get John or somebody to fix that. We will. The thing that I want to highlight is that on the put side, which is below the y equals 0, right? So that's all the stuff he's circling right there. That's telling us that it only goes down to 3,000 contracts. So in that 5-minute window, we had 3,000 contracts at those various strikes. And you can hover over them and it'll tell you what the number is and all that stuff. Okay, whatever. But take a look up at the call side. See how unbalanced that is now? And from the previous volume graph, the vol M graph, where you had the volume, you actually saw that you had a call spike in there. So this is why a DAB isn't one strike. It generally is broad, and it's a whole bunch of contracts firing to do offsets. So we see the signature all the time. All the time. And you can see how it's really filled in very, very nicely, right? So it to a certain extent, it looks like a bell-shaped curve. And what we like to do is we like to go to the center of that, and that's actually what the vol M tool and the centroids, that's what's being plotted, right? Volume and strike middle. So the takeaway from this is that clearly in that interval, we have a lot more call volume. It's not all over the map, very concerted, very tightly bound, right in the out of the money area, right? So we had a whole bunch of orders that hit the market right at that time. And then we saw a corresponding price continuing to move up as the dealers had to adjust on that, your dealer adjustment bars. So when you see stuff like this, you can get on the bus pretty quick. If you can get on the bus pretty quickly, you can probably ride that up or down. It happens both ways.
Yep.
Hopefully that's
Chuck,
useful.
yeah, Chuck, let us know if that answers your question or not. Yeah, I guess, Chuck, the thing too is like, right, don't want you to get analysis paralysis with like, oh, was that a dealer adjustment bar? Like, was that a dealer adjustment bar? Like, that's important, right? But these other tools are, I think super important as well. So let's see. It's like, for example, right, we're above drunken sailor range. Vol M is constructed for the upside all session. Market trend model is trending higher. Like, I don't care if there's a dealer adjustment bar or not. There could be there could be none throughout the entire day, but the trend is higher, right? I'm not waiting for a dealer adjustment bar just to do something, which I'm not saying that's what you're talking about, but for anyone, I think that helps. And that all the chart that you showed, you would think that the move is going to be up.
Well, I mean, so George, I'm not calling you out negatively here in your comments. Sorry, I'm changing topic here just briefly, but I'm just reading down the comments here. George, what I want you to get in the habit of doing so and holding others to this too. This is what I want you to do. I want you to say when. I can throw 7,000 out on the wall and be right. Okay? You think 7,000 is on the market scorecard. Well, sure. I can tell you right now, there is a scenario where 7,000 works. Not tomorrow. Okay? So what I want you to get in the habit of doing when you hold people accountable is ask them. 7,000 is great. 7,100 is great. We just had JPM come in at wherever it was. Where was it? It was at, let me check the notes. It was at 71.55. We're going to 71.55. When? Tell me when. Tell me the path. Tell me the path direction first to get there. That's what we do. All right. I have no doubt we're going to 7,000. I have every doubt that it's going to be tomorrow. So.
Yeah, 100%.
And again, I'm not directing that negatively at you, George. I love it when people throw numbers out on the wall. I want you to hold those people accountable. I want you to ask when and what's the path to get there. If they can answer it, good. To your satisfaction, great. If they can't, then you know they're just echoing what others are echoing. Right. Well, I agree. We're clearly going to go to 7,000, right? I mean, I can select a series of strikes right now where COI and POI are up at 7,000. Right. So that's going to be your point of maximum convexity. So it's going to take a while to get there. And I talk about it every morning when I do the SPX game plan. There are certain strikes in the way that until they get cleared, literally through monetization, we ain't hitting 7,000 until you clear those lower strikes. It's just the way the structure works. So, I mean, you could probably buy a January 7,000 call for next year and hit it right, but you might see it go down to 5,500 first. Okay. Time is not a factor for his position. Cool. All right. What else is on others' minds? I think, Chuck, we helped resolve what you had. I don't know if there are other chats that are out there that I'm not looking at that you guys might be.
No, there's not. There's just, they all get filtered through. I don't know if you're on StreamYard.
Yeah,
they all get filtered through that.
Okay. All right. Yeah, I see most of them are YouTube.
Yeah, I don't really have a ton else right now. I guess just looking at SPX structure as it is right now. Here we have all expirations selected. We can get to the top quartile in a second, but here, right, it's kind of predominated right now. We're below bottom of the transition zone. Right, top of transition zone is probably 6,900 or so. Looking at the top quartile, doesn't really change much, which isn't shocking. So, right, going back to how we let it off with the market trend model discussion, right? This is kind of just at least giving myself more kind of confluence into the dimmer analogy that, dimmer is not very high right now, if off the off position at all.
And that's the upper quartile right there?
This is, yeah.
Yeah.
Yeah, the scans are very, very narrow too. So if anybody's listening, we have multiple scans we run within the in the Discord to find individual equities, and the P-Trans and PGX scan is very small. So that already is just indicating that there's not a lot of stocks that are moving above the positive transition level for good entries into a little bit more bullish structure. So with a little bit of a tailwind. So I think that is that's usually a good indication. So.
Okay. Well, let's see. I did introduce, I don't know if you guys saw it up in, exactly, up in technical questions. That poor man's covered call document.
Yep.
So users in the Discord, you can go up there and read about a new strategy that we're developing. It's the poor man's covered call. So if you're familiar with Alan Elman and Blue Collar Investor and all that stuff, that it mirrors a lot of what he's written about and what BCI is all about and things like that. Where it builds upon a standard PMCC, poor man's covered call approach, is that it uses our levels to define where natural resistance would be, and it does a couple things, and it's all written in that document. So I would urge everyone to go read it. But the takeaway is this: in a general PMCC, just like in a general wheel, the idea is that you're long something and you're selling something else a much shorter dated against it. You're creating a diagonal effectively. And so if you're long a call and it's a deep in the money call, you can sell another call against it, a much shorter duration, and collect some premium. And the faster you can do that, that turnover, you're buying down, first of all, the time value of the PMCC, of the long call. And then if you eat into that and you get all the time value out of there, now you're, which is extrinsic value, now you're eating into intrinsic value, and you're starting to get paid for owning a stock that is, that you believe in, that you want to hold for the long term. So the goal of the strategy is for us to identify stocks and develop a methodology to be able to repeatedly collect premium against long positions, but use the gamma edge tools in such a way where we know the convexity patterns are. And so by intelligently selecting where you're going to sell that call, or perhaps not selling a call at all because the premium just isn't there, given the structure and things like that, you avoid the risk of assignment. You avoid the risk of the stock taking off, going through your short strike, and then risk early assignment. This helps take that off the table. And so my goal is to do this with, long calls and effectively leaps, which are just long dated contracts, very liquid generally, and as long as you stay in the big names. And we're developing a tool to help screen on that, and then tell you what strikes to look at. There's another key thing that nobody else does that we're going to be bringing to the table on this. And it's path analysis. And the path analysis is really, really simple. Let's say you buy 120 strike and the stock's at 180. What you want in that 120 strike is, I don't know, next year, a year from now, right? It's next January. What you want to make sure is that at no time does the convexity of any of the intervening months actually go lower than 120 on that strike. And so that strike selection for the in the money, deep in the money call is based upon the outcome of how that path dependency is established today. Now, that path dependency can change. We acknowledge that. We have no crystal ball here. We don't know what the market's going to do in the future, but we know how to look out over the horizon today. We have all the data to do that. And so this is going to look out over the horizon. So my ask of the folks who are members, go into this channel. It's up in the technical questions. Read that document. And if you got any questions, let's get them out now while we're still developing the code for this and the tools, and give me your thoughts so I can make sure that they're reflected correctly in the output. So we'll leave it at that. Jumping off my sandbox.
Very good. We talked about it already last week, but a lot of these common options strategies we can apply the game edge concepts to, and hopefully make them a little bit more superior for folks. So that's something we'll be digging into more as well.
Absolutely. Yeah, absolutely.
All right. Well, I frankly don't have a ton else to talk about. I'm not sure if you guys do or anyone in the chat has any other questions.
Mike? Okay.
think this is the first full week back. No interruptions in terms of markets and all that good stuff. So, I guess we'll be back. What leap are you buying? 27 or 28?
It depends. The system selects it for you.
Yeah, so probably just a set of conditions have to be met for it to pick which leap it's going at.
That's correct. That's correct. Yeah, and Tom, I'll put a little more breadcrumbs in the R&D thing for you, so you'll be able to dig a little deeper and ask all sorts of questions that I can't answer. So. Of course. All right. Well, that's a wrap then. Oh, wait a second.
Yeah, that's what we were just talking about. So this is the poor man's covered call. Oh, never mind. He's talking about the other one you posted, Paul.
Yeah, up in the garbage. Yeah. A couple. Yeah, those are informational. I mean, I can get a little more rigorous and repetitive in posting on those because I generate those things every weekend. But the PMCC strategy, I went ahead and already have started the PMCC strategy on ADI, so analog devices. And part of what got me to pull the trigger on that was what I put in that. Well, I didn't put. I mean, that's a compilation of a whole bunch of information in that research paper. But the idea there is we want to have a thesis, and we want to know when the thesis is being invalidated, right? If you're going to hold something longer term, you better know. You got to have a reason to hold it longer term than I bought it a year ago and I'm going to hold it longer term, right? The thesis has to be intact because it's just wasted money if you just sit on stocks for years and they don't go anywhere. Think of Ford. Like Ford didn't do anything for 10 years, right? Or 15 years. So trap money. You don't want to do that with your capital. So the idea behind those research papers is to be able to give you guys some things that I'm working on. And I know many of you are playing with the chat bots, right? With OpenAI and Claude and others. You can take these PDFs and you can feed them in as a reference document and say you want to create your own prompts to it. You better get pretty close to the same information because almost every piece of information that I have in those documents has been brought in from 2 different sources. So, or more, but at least 2. So just make sure that if you do create your own prompts that you have multiple ways of checking it because those damn chat bots lie all the time.
They don't lie, they hallucinate.
They are on magic shrooms more than I ever was when I was a kid. So.
That's funny.
Yeah, that's crazy.
Chuck, one last question. Yeah, so it's not a tool we're previewing per se. It's been in production for a week or 2. But yeah, the heat map, I mean, so there's 2 things. One, we don't really have in production yet, nor is it really slated to be in production anytime soon. But first off, the questions you want to answer is this stock I'm looking at like even, subject to the influences of the options market? And so if it's not, then, you're wasting your time going through this. Like if there's 10,000 net open interest, then really not worth looking at. And then the second one is, okay, the stock likely has some influence in the options market. Then, what are the significant expirations we can look at, right? Where there's a meaningful amount of concentration. And that is what these heat maps is a quick way of helping us see, right? Is kind of the more pronounced purple it is, the more exposure is sitting at those strikes. And then right down here, you can look at kind of the top 25% of expirations, the middle, the lower than the bottom 25%. And so, Paul has started referencing the top 25%, which is, 71% of all exposure in the name, in the pre-market notes and things of that nature. So that's the way that we are going about using that kind of new tool.
Yeah. And I'm loving that quartile separation. I think that's a very interesting way of presenting the data. So we'll see how we can leverage that even more and more.
Yeah, it was kind of a happy accident that got created, but glad it did. So, Chuck, does that answer your question? Looks like Tom's going back to cleaning. So good night, Tom.
All righty. Well,
all right. Well,
I think it's a wrap.
Chuck, yeah, you know how to find us, Chuck, if that didn't answer your question. So we can go from there. So, all right. Well, appreciate everyone's time tonight. And we'll see you all right early in the morning tomorrow. So
you will.
Adios.
Adios.
All right.